Hello everyone, welcome to another financial analysis video with myself, Moeed Amin, and my colleague, Ted Wayman. The goal of this show is not to give you investment advice, although you might want to use the information to do so. That is in your discretion. The goal of this show, to remind everyone, is to help people become more knowledgeable and in terms of financial analysis, reading financial statements, to inform them whether you are thinking about investing in the company, whether you're thinking about doing business with this company, or even if you're taking an interview with them. Our goal is to actually teach you how to read financial statements and how to become more financially savvy. So don't forget to like, share, subscribe if you like those videos. So today we're going to be looking at a Chinese company. So first time for this show, but definitely not first time for Ted and I to look at a Chinese company, of course. And today we're going to look at Tencent, and it's a big one that we're looking at today. So Tencent is a tech and entertainment business. It's one of the largest companies in the world. It's actually the largest video gaming company in the world. And you will see, we did an analysis of a company in the past, Disney, and we showed how they have a stake in over 200 companies. Well, get this, Tencent has a stake in over 600 companies. So just to give you that kind of size, and the companies that are involved in cloud computing, entertainment, gaming, as I said, fintech, technology, and a whole host of others. And just to give you another idea of the size of this company, they have as of this recording in March 2022, they have 86,000 employees, so quite a sizable business. And we're going to go into the financials about this company in a moment. But before we do so, just to give you an idea on the share price. So they are IPO. Well, they are actually listed on both in both the US stock exchange and the Chinese stock exchange, specifically the Hong Kong stock exchange. So they IPO'd in 2004. Now, if you'd invested back then, you'd be sitting on a handsome profit indeed, a profit of 47,000%. Now, if you'd invested 5 years ago, you'd be sitting on a profit of 73%. And if you invested a year ago, because of everything that's been going on in the market, you'll be sitting on a loss of 43%. But we're going to dive into a bit more around the details behind that in relation to what we're looking at, the backward-looking financial statements. So remember, this is all retrospective. We're not looking at future statements for here because we're helping you understand how to read those statements so you can look at those future statements, those quarterly statements on your own with our help on how to analyze that. So let's get to it and share what we found about this company and some information there. So Ted, take it away. Although one thing to note, actually, I forgot, this came as a request from a couple of our viewers, right? So, over 95% of our videos and the companies we analyze actually come from requests from you, the viewers. So Dominic and others, thank you for your request. And don't forget, if you want us to analyze a company that you're really interested in, do leave a note in the comment section and we will get to it. We get a flood of them, but we will do our best to get to yours as soon as possible. So Ted, let's take it away and share with our viewers what we found about this interesting company.
Hi, Moeed. Yes, thank you very much indeed. So good to see you and good to see all of our viewers. Apologies if you think we've been away for a while. We've been incredibly busy, but we're back with a vengeance. So here is Tencent, incorporated actually in the Cayman Islands. This is their annual report. It's available on their website, relatively straightforward. It's interesting enough, the annual report is for 2020. So they haven't released their 2021 figures yet. So we're still in 2020. There is the half year for 2021, and we'll have a quick look at that a little bit later on at the end of this video. But what we're going to do is look at the kind of the audited numbers for 2020 and get a feel for what is going on in this company. Okay, so here we go. We are dealing in basically in yuan, in RMB, and we are in millions. So we're talking about billions. So 264,000 million is obviously 264 billion. So turnover is 482 billion. Okay, so there's a turnover, 482 billion, and that is a significant, a 20% increase, a 28%, sorry, increase on the prior year. Okay, so this company is growing and growing rapidly. Cost of revenues here, so that's the cost of the kind of, you know, the games, etc., etc., and a very, very healthy 46% gross margin. So basically, every time they bill a dollar, it costs them 50 cents to provide that service, whether it's a gaming service, whether it's a fintech services, etc., etc., etc. So very, very profitable business here. Scroll down a little bit further down our income statement, and we've got the cost of running the business. So these are the main costs of running the business down here. Other interesting one is this one here, big net gains coming in. This is kind of other gains. So this is a significant number. And because it's a significant number, we ought to go and have a look at it. So let's go and have a quick look at note 7 and just see what that is going on there. And I'm going to guess that this is some of those investments that you were talking about, Moeed, earlier on. So we're just going to confirm that by looking at note number 7. You see it kind of coming up here. So here we go, other gains. And this is, yeah, so this is the net gains on disposals of investee companies. So and other fair gains on a fair value profit and loss basis. So those gains, just to note, these are realized gains. They've actually kind of banked the cash. These are unrealized gains. And obviously, as we know and experiencing in the markets, what goes up can go down as well. So it is possible that they may book some losses, having booked some gains in the past. Okay, so caveat, just a sort of little caveat around that. So there's a you know, and that's a significant amount. You can see those numbers. Those are significant drivers. They are not immaterial. Still making a, you know, very nice healthy operating profit. So operating margin about 38–40%. Got some finance costs, not a problem there. That's the interest they're paying. So we're going to find some debt, and they are paying tax. Still profit for the year, 160 billion, so 160 billion RMB, looking pretty healthy there. I just want to note down here the earnings per share. So you'll notice the earnings per share, this has gone from 98.5 to 16.4. So it's always worth just having a little look at that, just to see the kind of the extent to which it's growing. So that's a growth of about 71%. Okay, so
just to note, it's 9.85, not 98.5.
Oh, sorry, yeah, 9.85. Sorry, that's my reading my decimal places in the wrong place. Get some new glasses made. So 9.85 up to 16.8. That is an increase of about 71%. Okay, so that's a sort of fairly substantial increase in the profitability of the company, compared with a top line increase of 28%, as we referenced earlier. So there is the income statement, looking pretty good so far. So let's go and look at the financial strength of the company, sitting, you know, the balance sheet that sits behind it. Here is the balance sheet. So we are looking now at the non-current assets. These are the things we need to run the business. Quite interesting, and again reflecting something you were talking about earlier, Moeed. So we see the property, plant, and equipment. This is kind of typically what you see in in any business. They'll have property, plant, and equipment, but the big numbers are really popping up here. So we have got these investments in. So you've got some intangible assets, that'll be goodwill, for example, in there. They've got investments in associates, which is where they own a substantial amount of the business, so typically around about 40 to 50%. Investments in joint ventures, which is where they own, obviously it's a joint venture, so 50%. And then also we've got these financial assets at fair value through profit and loss, and financial assets at fair value through comprehensive income. Now, the difference between these two is that any gain or loss on this one here is recognized as a profit or loss through the profit and loss account that we were just looking at. So that 50 billion, I think it was, a gain. these are not recognized until we actually sell them. So there's a bit of a distinction there. But what this is telling us that they've got these substantial amount of investments. Now, one of the questions we kind of have is, what are these investments for? So typically the investments we're looking at up here, so joint ventures, investments in associates, they're going to have, they want to have control over these businesses. They're substantial investors. Okay, so those are usually quite strategic investments. I want to buy this company, or I want to have a control of this company because it's going to distribute my software or help me market or whatever it is. These could be the same thing, but they have no control over them. They don't exercise control. They got a substantially smaller, maybe 5, 10, 15, 20% shareholdings. And therefore these ones, they could be just that's somewhere they're parking surplus cash. Okay. So the question is that effectively, for our point of view, are we just treating it as a cash figure and they're parking surplus cash, or are they making strategic investments for particular reason within the business? I don't know what the answer to that is. However, if somebody's watching and does know the answer, I'd be very interested to hear from you. Current assets, things that we own that we're trying to turn into cash. Nothing really kind of jumping out at us, apart from the fact that they do have a lot of cash. So these three numbers together are a lot of cash. So they've got a lot of cash, and it looks to me like they've got so much cash that they're parking some of it up here. They're just investing in anything they can, get that cash out, they get it working for them. We live in a world of very low interest rates. And then they've got these accounts receivable, which is what you'd expect, and some pretty small inventories. And again, because it's an electronic games company, they're not really going to hold inventories. So current assets, non-current assets. Non-current assets, very, very large, but looking to me mainly like those non-current assets. This big trillion number up here, this is mainly driven by their investments in all of those subsidiaries, et cetera, that you were mentioning earlier, Moe. Come down to the liability side. In fact, we have to just drop right down to get to the current liability. So these are the amounts that they have to pay soon. So accounts payable, as we'd expect within there, they've got a few other payables in there. A little bit of debt, that's not a problem. We expect them to have some debt they have to pay quite soon, as opposed to debt that's payable further down the line. And also just jumps out at me this big number here, deferred revenue. Just as a reminder to what that is, that's income they've received but they haven't yet earned. So if they're selling, say, a year subscription to a platform, if you pay up front, then they have to recognize that as a sale over the future period. So they don't owe it back to the supplier, they really owe it to next year, and they'll recognize that revenue as revenue in the next year. So this is really good for a cash flow. Any company with lots of deferred revenue tends to have very strong cash flows. So the current liabilities to 270 billion. Compare that to the 317 billion of current assets. Liquidity really is not an issue, and as I said, they've got cash stuffed, so in the attic, so to speak, as well in the non-current assets. So really, liquidity is not looking at all like a problem for these guys. In fact, too much cash could be the issue for these guys. Now, they do have debt, so they are paying interest. We notice they're paying interest. They do have debt. That's absolutely fine. This is a world of very low interest rates, so they're taking advantage of that. They do have some debt, but the debt is not excessive. It's only 286 billion in total for all of their non-current liabilities, and that means that they have a very healthy total equity line for the business, and that total equity line primarily driven by these retained earnings. So you see the retained earnings there of about 538 billion, and that is really as a result of the fact that they are making substantial profits and not really paying out a huge amount as a dividend. So let's just check or just show where we can see that. So if we go down to the consolidated, this is the movement in equity. We can see, I think this is the current year we're looking at. So there's the profit during the year, and down to the comprehensive income. And then if we scroll a little bit further down, let me just get my scroll figure. Here we go. So if we scroll a little bit further down, we can see that where we got the yeah, so there's the dividend. So there's a little bit of a dividend being paid out there. There's our dividend. So, you know, a very small amount being paid out as a dividend. Most of it is being reinvested back into the business. And again, in the previous year, substantial profit for the year. There's our profit for the year. Again, if we scroll down, we can see a very small proportion of that is being paid out as a dividend, and no share buybacks either. So there's our dividend. So equity funded business, little bit of debt, lots of you know, predominantly funded through retained profits, very, very profitable. Those profits all being held in the balance sheet, funding future growth, and the company is kind of, you know, flying basically. Here is their cash flow. So as we'd expect, very strong cash flows from operating activities. So just so that we kind of put that into perspective, the cash flow is the operating cash flow 194 billion. Their EBITDA 235 billion. So again, you know, pretty similar as we'd expect. And they are making, you know, just generating lots and lots of cash. So really, really strong cash flows for this company. In terms of their investing, we have to be a little bit careful about this because, you know, typically what we would do is we would go and look at this number down the bottom and just look at, you know, what is their investing activities, 182 billion. But that's a little bit of a distraction, I think. So we need to pick this apart. So when we look at this, what we see is, if I just pull out some key numbers, so things like kind of, you know, the purchase of property, plant and equipment, you know, for any business that is investment. However, here you can see buying associate companies, they are buying financial assets at fair value, they are buying you know, more investments, and again, some of these later ones, I think this isn't really investing, this is parking cash, or it's investing, but it's not investing in the terms of like someone like Coca-Cola would talk about investing in plant and machinery. These guys are just, you know, they've just got cash and they don't know what to do with it, so they're just parking it somewhere. So that kind of that look here of this kind of, you know, this negative 182, or this, you know, this capex of 182, I think, you know, most of that is actually related to, you know, just investing spare cash. Just as you and I, Moe, you know, if we won the lottery, we might go and buy, you know, shares in the stock market type of thing. And then finally, the financing activities. So here we see, you know, lots of kind of, so all of this bit up here, this is really just, you know, refinancing going on. So they're borrowing money and repaying money. You can see the dividends are coming down here. There's the dividends that they're paying out, and that's really, you know, that's pretty much the kind of, you know, a little bit of interest they're paying on the debt, and that's really the kind of the story. They're not obviously issuing any shares, they don't need to, there's no reason to go to the shareholders to raise money, and we can see that the cash has just basically been growing from, you know, sort of year on year. So there's a kind of, you can start to see the increase in cash, you know, and that's pure cash. But this company has more than just pure cash. It's just got so much cash, it's kind of, you know, falling over, and therefore investing. So that's kind of the, you know, that, you know, it's just, you know, it's almost like a money printing machine. This company seems to be. So let's just have a quick squiz at the latest set of accounts. If I can just pull them up here, I think I've got them down in front of me. So here is their kind of their latest set, and we're just going to look at the balance sheet. Won't have changed that much. Balance sheets don't tend to change, you know, significantly. So we'll just have a quick look at their the income statement. And here it is, and again, you know, just to kind of, you know, we can take a real rough guess. So if we take our 6 months, for example, and we say, look, you know, here's the revenue for 6 months, 273 billion. If we double that, we get to 547 billion. and doubling is, that's just my finger in the air. And if they achieve 547 billion top line, last year, if you remember, it was 482 billion. That's a 24% year-on-year increase. So, it was 28% from 2019 to 2020. I'm forecasting a 24% from 2020 to 2021. We're going to know quite soon. 2021, a full year is going to come out, reasonably soon. And again, the gross, let me just scroll that up a little bit so we can see the rest of the numbers. So there we go, profit for the period, 92 billion. So if we double that profit for the period, we get up to 184 billion, which is a 34% net margin. That's similar to 2020. So they're still operating at a 40% gross margin. So, that's nearly 50% every time they bill someone, cost them 50 cents, they get to keep 50 cents. Costs of running the business are negligible. Again, just to kind of highlight these other gains, going to be quite interesting. Since these numbers, markets have gone a little bit, maybe that's going to kind of come back. So there's going to be maybe a little bit of carnage going on in there, but it's not going to knock this company off. In spite of even if some of their investments start to go down in value, I don't think that's good. It's not going to bring this company down. It may lessen the value of this company in the eyes of the market, and maybe that's a buying opportunity. But fundamentally, this is a profitable company. It's generating cash, and the margins are looking pretty healthy. So with all that in mind, and as you mentioned, Moeed, we don't talk about giving investment advice, because there's many people out in the world who can do that much better than us. But we always like to look at the share price and just see what is it telling us about this business, and maybe kind of think about, so there's our historical share price. Obviously, the benefit of hindsight. If I sold my house and bought shares in Tencent back when it floated, I would be sitting on my super yacht right now. So market cap 3.7 trillion. You notice this is in Hong Kong dollars, and the numbers we were looking at in RMB. So just to sort of caveat that that there's an exchange rate in there, but even so, 15, 16 times earnings. What, 16 times earnings? That's long-term trading of the S&P. That's not unreasonable. That's to put that into kind of perspective, that's a yield of about 6%. Okay, so it looks, you can see it's obviously spiked. It's come right down again. It's come right off the boil. If I was a chartist, then I would be, one of these charting analysts. I'd be kind of, lining up these and sort of looking at where it's going. And then what I'll probably be trying to do is to line up these and look at where it's going. And you might conclude at this point that that becomes a buying opportunity, because it's going to kind of come round and go up. Now, we have to be careful of that. We're, slightly entering into a new era of higher interest rates. However, this is a cash generating company. This is not a jam tomorrow company. This is very much a jam today. So that price to earnings ratio doesn't look like it's not a screaming buy, but it's not a screaming sell either. Dividend yield is very low, but we know that because it's actually, it's paying out a low dividend. There's no reason why they can't start to raise that dividend. They are generating the cash. They can afford it. And if there are no opportunities out in the market, then maybe there's an opportunity for these guys to give the money back. Alternatively, if their strategy is very much to reinvest, you could argue that as the markets have been tanking, that creates buying opportunities for cash-rich companies such as Tencent. So that's kind of what we're seeing there from the share price. It wouldn't appear that it's I wouldn't avoid it. Let's put it like that. So there you go, Moeed. I think that's about all I can add to the add to that. So great company, very profitable, lots of cash, very strong cash flow, very strong balance sheet. Almost too much cash. What is it going to do with it? Is it going to carry on growing? Is it going to go to the, keep going to the stars? Obviously, it's, it's pretty much in the stratosphere already. Or is it going to kind of trip over? And I don't, I'm not really in the gaming world, so I don't know the sort of the quality of its products, and I don't know the kind of, the stickiness or the how whether it's a kind of a fad thing where everyone's playing it today and no one's playing it tomorrow, for example. What their kind of the Boston, the BCG matrix, their kind of cash cows, and what they've got coming through the pipeline and the way they manage that. But it looks to me like it's a well diversified company.
Yeah, thank you for that, Ted. It's very interesting. So again, love to hear everyone's comments. If you know this business very well, if you know its products very well, do leave your comments in the comments section. We'd love to hear that. This is a community at the end of the day, so we're here to inform each other. As always, like, share, subscribe. And don't forget, if there is a company that you would really like us to analyze and you would like to know more about that business for whatever purpose it is that you're considering it, do leave a note in the comment section and do put some context behind that, right? So tell us, is this for an interview? Is this for, a sales conversation you're going to have with them? Or is this for investment purposes? The more context you get, the more likely your video will be prioritized in a long list of videos that we have. So until the next video, thank you, Ted. Thank you, everyone. We'll see you in the next video.
Catch you later, Moe.